Welcome to the Explainer, where we break down the big stuff. And today, boy, have we got a puzzle. A real financial mystery that's got every investor in India scratching their heads. Okay, so picture this. Markets all around the world are green, just soaring. But back home in India, it was a completely different story. A sea of red. Just not what anyone wanted to see. So the big question is, why? Why is India's market falling when everyone else is doing so well? All right, let's dive in and really unpack what's pulling our market down. Okay, so here's our game plan. We're going to start with the main event, the rupee hitting a record low. Then we'll look at who's actually winning and who's losing from this whole situation. After that, we'll tackle the global headwinds pushing against us, a really serious liquidity squeeze, and we'll wrap up by zeroing in on some key stocks that are right in the middle of the action. All right, first things first. Let's talk about the prime suspect here, the big one, the Indian Rupee. I mean, it's hit an all-time historic low. We're talking nearly 90 against the US dollar. That's a huge deal. And look, this didn't just happen overnight. This has been a trend building up, and it's really intensified lately. It's all being driven by something economists have a fancy term for, the twin deficits. So what are these twin deficits? Well, the first one is the trade deficit. And honestly, it's pretty simple. India is just buying way more stuff from other countries than we're selling to them. And that gap, it just hit a record $41 billion. When you have a gap that big, it puts some serious pressure on the rupee. Yeah, this really breaks it down, doesn't it? Think about it like this. For every 100 rupees worth of goods we sell abroad and get dollars for, we're turning around and spending 200 rupees to buy things from abroad. That kind of imbalance, it just creates this immense pressure on our currency, dragging its value right down. Now, the second part of this twin deficit problem is something called the capital deficit. You can just think of it as a huge investment drain. What's happening is that big foreign institutions are selling off their Indian stocks and pulling their cash out of the country. And the problem is, there's just not enough new money flowing in to make up for it. So, okay, we've established that a weak rupee is a major issue. But here's the twist. It's not actually bad news for everybody at all. This whole situation creates some very clear winners and some pretty big losers. And wow, this really lays it all out, doesn't it? It's like two different economies. On one side, you've got the winners, IT and pharma companies. They earn in dollars, so a weaker rupee means they're actually making more money when they convert it back. Exporters, too. But then there are the losers. And that's, well, pretty much the rest of us. It means higher inflation. Students studying abroad suddenly find their fees are way more expensive. And for you and me, it means paying more for anything imported, which is a lot of stuff. You know, when the currency gets shaky like this, investors start looking for safe places to park their money. And a classic safe haven is precious metals like gold and silver. Take a look at silver. For 5 straight years, demand has been higher than supply, which has been great for its price. But here's the catch, and this is important for investors. That deficit, that gap between supply and demand, is actually starting to get smaller. That could be a sign that things are about to change. So, as if all this wasn't enough, it turns out our problems aren't just coming from inside the house. There are some major global headwinds, external pressures that are just adding fuel to the fire. Right, because India doesn't exist in a bubble. For instance, over in Japan, they're talking about hiking interest rates. When that happens, money just gets sucked out of global markets, including ours. Then you look at the US. They've still got these high 50% trade tariffs on us, while our competitors like South Korea and Japan are only paying 15%. So you can see how all these external things just pile on and make it tougher for our economy. Okay, so we've got the weak rupee and global pressures, but there's another really big piece of this puzzle, and it's happening right here at home. We're talking about a serious cash crunch in the market, what the pros call a liquidity squeeze. Just look at this number, 30,000 crore rupees. That's a mind-boggling number. And it's the value of stocks that have been sold off by company insiders and major investors in just the last month alone. All that cash is just being sucked right out of the system, leaving less money available to push other stocks up. And it's not just those big sales. At the same time, we're seeing a flood of new IPOs hitting the market. So you've got this massive outflow of cash from the big players and a ton of money from regular investors getting soaked up by all these new company listings. It's a double whammy, and the result is simple. There's just less cash left in the pot to buy existing stocks, which naturally pulls prices down. All right, let's narrow our focus for a second. I want to look at one specific part of the market that got hit particularly hard today, the banking sector. And the reason for this is fascinating. It's all because of a major rebalancing act that's happening behind the scenes. So here's what's going on. The Nifty Bank Index is basically getting a makeover. Its recipe is changing. Now think about all the huge funds that are set up to automatically copy or track this index. They have to adjust. So they're being forced to sell off shares of the heavyweights like HDFC Bank and ICICI Bank just to bring their holdings down to the new lower weightage. This has nothing to do with how well those banks are actually doing. It's just mechanical, forced selling that's pushing their stock prices down. So what's next? Well, you're going to want to mark your calendars for these dates. We've got big decisions coming from the RBI, the U.S. Federal Reserve, and the Bank of Japan. What they decide to do with interest rates, well, it's going to have a huge ripple effect on everything from our currency's strength to the entire market's direction. So yeah, definitely dates to watch. And all of this, it brings us to one final really big question. You've got insiders cashing out, tons of IPOs draining all the available funds. Essentially, the smart money seems to be getting cautious. But at the exact same time, retail investors, everyday people, are still pouring money in. So the question is, can that retail spirit, that optimism, can it alone be enough to sustain the market's next move? Or are we headed for reality check? That right there is the mystery.